need to capture many of the elements for them. So good morning, everyone. It's Angus Warren here. I'm the Managing Director of WBC. We are a specialist oil and gas training company. We help individuals and companies develop their capabilities in leadership and management in the oil and gas sector. And in fact, we've been delivering training in Nigeria for many years now, many visits to Lagos to deliver classroom-based programs. And I'm delighted to see a few of our alumni on this call here today. So a special welcome to alumni from our programs in Nigeria. I'd also like to introduce Daniel Stewart Roberts. Daniel is WBC's chairman, and he'll be helping out in delivering this webinar today. Daniel is a UK-based chartered accountant. He was a partner at Deloitte in their oil and gas division, and then went on to take on many finance roles, including finance director in E&P companies, listed and private equity backed, covering the UK, Europe, and Russia. And interestingly, his last company job, oil company job, was with a firm that was redeveloping mature oil fields in Central Europe. And of course, redevelopment of mature fields faces many of the same challenges that we see in the marginal field situation. I'd also like to introduce EMR. EMR is WBC's partner in Nigeria. I'm delighted that one or two of the folks from EMR are on the call. EMR is a consulting firm that provides subsurface services to E&P companies, particularly in the areas of geoscience and engineering. So welcome to the EMR folks that are on the call. In terms of timings, we'll present for about 40 minutes or so. That'll take us to around about 11:15. We'll then have plenty of time for questions and answer. And so it should be about 1 hour in total. We should be spending about 1 hour together in total. There will be a recording available of this webinar, so I'll send you a link to that after this event is finished. So if you need to catch up or remind yourself of anything, there'll be a recording just for you. And I'll also send out the slides to the program. Okay, so with that, that said, let's move straight into the agenda for this webinar. And what we're going to do is present to you the, as it turns out, 14 key elements of a well thought through business case for the oil and gas industry. And you can see these presented to you here on this slide, and they're arranged in 3 groups. There's the what and where, so what are you investing in, where are you investing? The why, so the rationale or the reason that you want to invest, and then the how and the when, so when are you going to be making your investments and how are you going to go about it? So we'll be covering in the what and where the resource, local country assessment, market assessment, any applicable laws and regulations. Under why, we'll be looking at the strategic fit with your company, the economics, of course, that's important, any competitive issues, competition issues, and downstream opportunities. And then in the how and when, we'll be looking at the granting instrument, the importance of granting instrument, development concepts, finance, infrastructure, supply chain, and HSSE, health, safety, security, and the environment. So it's quite a broad agenda. So obviously in the time available, we're not going to be able to get down to the very last detail. But what we do hope to do is to be able to leave you with a checklist or some items to consider when you're developing your business cases for marginal fields. Some of you may be developing business cases, others may be reviewing them in some shape or form, but I hope you'll leave today with some thoughts on some of the things that you will definitely need to consider as you go about that exercise. So it'll be quite high level concepts, and I hope then that you can take these concepts and apply them in your own situation. Okay, so with that said, let's get into the what and the where. And the starting point is really the resource, the oil and possibly gas that's present. Obviously, a crucial factor. How much oil do you have? How much gas is present? So usually we look at this in several areas. We look at the play and the basin and the prospectivity there. And I think for the marginal field case, there's probably quite a lot of data available on this. That would be my guess, because we're talking about fields that are in blocks that may have other discoveries nearby. And so there should be a reasonable amount of data around and a good understanding of the geological model. So you'll want to take this and you'll want to understand the size or the potential of the field for your business. Is it material? And does it offer your company growth prospects? Now, for those that are putting together new organizations or new vehicles to bid on the marginal fields, this field may be your only asset, and so that will be a very material part of your business. But for the bigger companies, you have to decide whether one field, perhaps a small field, will in fact be material and offer you significant growth prospects. And then, of course, you'll need to think about the type and quality of hydrocarbon. And of course, this will influence how you develop the field, how you extract the oil, how you process it and transport it, and in fact, what price you get. So I would imagine that there will be some at least starting data on the type of oil and the quality of the oil that you're dealing with. And in fact, if there are any other hydrocarbons there, so light oils, condensates, and perhaps gas. Okay, so we'll then need to look at risks and uncertainties in the resource. And of course, the big three are the volume risk and uncertainty, the rate risk, the production uncertainty, and any quality issues around the oil. And we'll look at these in a bit more detail later in the presentation. So you'll be left with some data around what the reserves are for the field, any contingent resources and prospective resources. And I think it's worth just before we move on, reiterating or introducing you, for those that are new to this, the idea of reserves and resources. The reserves are what you expect to extract from the field, whereas the resources are what is in the ground. So a key part of the marginal field business case will be assessing what oil you think you can recover from the reservoir, the recovery factor. This will be a key part of your business rationale. And of course, the recovery factor for a field is a very complex concept, because it's influenced by so many things. It's influenced by the geology, for example, the oil type, the technology that you deploy, the granting instrument, the OML that you have, so there, and lots of others. So it's quite a serious undertaking to understand exactly what recovery factor you expect to achieve with the field that you're working with, and you'll need to present that you've actually understood this and can articulate that. Okay, so then we move on to the local country and regional assessment, and I would expect the understanding of that to be quite mature. We're talking about oil fields that are in existing blocks with existing discoveries potentially and existing production, and so the general situation is well understood. And in this case, of course, we have DPR taking the lead, so we'll want to give some consideration to the role of DPR and also how it relates to the role of the ministry and MPC. It might be clear today as you're preparing your bids, but we need to allow for the possibility that the situation will become dynamic and may change. So if you are fortunate enough to win a bid, several years into the project, you may find that the dynamic changes, and so we need to understand that at the outset. Security might be an issue, and I'm sure you'll be giving some thought to the challenges, particularly in the Delta region. And then we need to give some thought to the overall economic conditions. So are there any local factors or regional factors that we need to consider around the economic parameters such as inflation or currency or oil price? Local and regional capacity is all around what capacity we see in the industry to actually go out and develop these fields. So do we have the service companies with the right skills and equipment available to help the industry to develop? So that's an assessment that you will need to make. And what role does the industry play in building up these capabilities, and what role is expected by the government? And lastly, we might do a PESTEL analysis. So PESTEL is quite a well-known technique for organizing our analysis of the general situation. It's a nice way of organizing our thoughts on around the regional and country assessment. And it's very simply politics, economics, social, technology, legal, environment. A very simple tool, but a good way of bringing everything together. Okay, let's talk a little bit about market assessment. So we're still in the what and the where, but now we're turning our attention to the oil markets. Now, it's amazing to me quite how often E&P companies get this wrong. It happens frequently, actually. I think as an industry, we tend to think more about the resource and what's in the ground and the subsurface aspects, and perhaps a little less time thinking about how we're actually going to market and sell any production. And in fact, a great example of this is Tullow in Uganda. And you may remember in the 2000s, Tullow had great exploration success, but obviously didn't think too much about how it was going to sell or indeed transport oil to the marketplace, because they're still grappling with that, and it's been a big challenge for them even today, 10 years later. So we do need to give some thought to the market assessment. Now, I know it's going to be a very different situation in Nigeria to Uganda with the marginal fields, because, as I've mentioned earlier, these fields are often in blocks where there's existing production, existing infrastructure, and so there's a well sort of tried and tested methods for getting oil to the marketplace and for selling it. But we should still give some consideration to this, particularly if there are any risks or unusual situations that we might find ourselves. So give some thought to the markets that you're going to serve, how much oil you're going to sell, where that oil is going to go to, who you're competing with, what sort of prices you might get, particularly if there are any reasons for discounts. Perhaps your oil is of a slightly lower quality. And so you'll need to give some thought also to how you're going to get the oil to the marketplace, what the transportation and storage requirements are, and any blending issues. And we'll look at infrastructure very shortly. But think about blending. There's a very good chance that your oil will be blended with other oil. And what does that mean? What are the quality differentials between the oils that are being blended? Are there any nasties, for example, in your oil that might cause problems for the blend as a whole? So you will have data on the oil that's in the marginal fields, I hope. And so giving some consideration to this at the outset could prove very valuable to you. Okay, so that's a little bit about the market assessment. Let's think a little bit now about local laws and regulations. Obviously, you'll need to be familiar with the industry structure. And we talked already about the ministry and the roles of NNBC, the ministry and DPR, who is leading this. and also the application of company standards versus required standards. So this could be quite an important area for you, depending on the type of development that you envisage. The local standards that are required may be different to your company standards, and this might either have a cost implication or it might also have a benefit to your operation. So it depends very much on the situation that you're in and the field that you're developing, but could be worth some consideration at the outset. And then, of course, we need to think about stability and any risk that we're taking on around the change in politics or laws and regulations. The last point I wanted to make is around local content. Of course, we have the Nigeria Content Act and some important requirements on companies operating to use local suppliers or local equipment and local labor. So this might be an important consideration to make while you're developing the business case. Okay, we're now going to jump into the why. Why are you investing? And the first aspect we need to look at is the strategic fit. What opportunity or what fit does a marginal field that you're looking at, what fit is there with your company strategy? What competitive advantages does it give you, or what competitive advantages do you already have that you think would be very applicable to developing this marginal field? And these come in different categories. So, for example, technology might be an area where there's a great strategic fit with your company or business. And so you think in marginal fields that technologies such as enhanced oil recovery, 4D seismic, and when I say technology, I use it in the very broad sense to include experts that you might have access to either in your company or in your service companies, that might, rock star reservoir engineers, for example, that might be able to add a lot of value. Any processes that you have, perhaps you've worked on marginal fields before and you've gotten to understand and develop processes that can add value. So these would be all good examples of where a marginal field is a great strategic fit with your business. And then, of course, think a little bit about the geology and the hydrocarbon and where you are in the life cycle. I mean, obviously, with marginal fields, we're talking about the development phase. And so the development phase, the development activity is going to be a core aspect of the business case. And therefore, if there's a strategic fit with your company's capabilities, you will be in good shape. Think about markets served and any synergies that there might be with any existing business. So I'm thinking here, if you're a company that's bidding on a marginal field that has production in the area and perhaps infrastructure in the area, those can be some great synergies for you that might not be available to your competitors, might not be available to other companies that are bidding. So have a think about any synergies you have with markets served, and you can leverage these synergies across the business. They can be technical synergies, commercial synergies, operational synergies. There's a whole range of things that you might do or leverage that would give you some advantage. Thinking also a little bit about your bidding strategy at this point. How are you going to go about bidding? Are you going to bid on your own? Will you be bidding with another oil company or perhaps team up with a services company? And I know that in the marginal field process, there is, although it will be local companies that are bidding initially there is scope to bring in foreign partners up to 49%. So what role do you think a foreign partner or a foreign investor might play? Or perhaps you're very confident in your own abilities and you're got a lot of experience in this area, and you might choose to sit out the bidding process altogether and wait for somebody else to win a bid and then approach them to do a joint venture with them. So it's a very specific case, but think strategically also about the bidding strategy. Okay, competition. So what we are talking about here is the competitive strength of the opportunity. So in other words, how good a fit is it with your business, and the competitive strength of your business in terms of the opportunity. What strengths do you have that your competitors or the other bidding companies do not have? And in turn, what kind of competitive threat might other companies or other bidders pose to you? We do work in a resource business. So if you do not have access to the resource, that probably means your competitors will have access to it. So what does this mean for you? What does it mean for your, if you have existing business in the region or in the country, what does that mean for your business? And of course, the reason that we need, one of the reasons or prime reasons we need to understand our competitive position is it will influence our bidding strategy and any premium we think we should make to the bid. So our competitive strength will allow us perhaps to bid more. So if we feel we are uniquely positioned to develop this asset and to turn it into a really good business, this will allow us to in fact bid more than our competitors at the bidding stage, and therefore increase our chances that we will actually win the bid. Okay, so now we're on to economics. So I'm going to hand over at this point to Daniel.
Okay, good morning, everybody. We're still working through the why section of the business case, and the economic section is obviously very important. It's where you'll demonstrate how a project will create material value for your company. Clearly, the absolute value that can be created will be important, but relative value may be important as well. You may be competing with other projects for available capital, so we'll have to show that the potential return justifies the investment. Or you might be deciding between a number of fields in the bid round. So you may want to compare the potential returns from each field so you can decide which is the best to bid for. You'll do this with a financial model, and unless it's a very quick project, which I think is unlikely in this case. If it's very quick, the time value of money won't be a factor, but if assuming it is, you'll almost certainly create a discounted cash flow model to calculate the net present value of all the expected cash inflows and cash outflows, which I guess is a concept that will be familiar to most of you. The model will also enable you to calculate the internal rate of return for the project. This will be particularly important if you are planning to target looking at multiple fields, because you'll then be able to rank them and show which offer the best returns. Or alternatively, your company might have a fixed target hurdle rate that it aims for, and you'll need to show that this project will exceed that hurdle rate. There will be a lot of uncertainties on both the income and expenditure sides. So the model shouldn't be a precision exercise. You're not modeling to 10 decimal places, but you do need to make sure that all the significant CapEx and OpEx cost elements are included. For example, you'll need to make sure you fully understand the tax and royalty regime and model all the tax outflows accordingly. You'll also need to understand your decommissioning obligations and build in the costs that arise from those. If you forget those, you could have a big hit at the end of the project, which you haven't taken account of previously. You'll need to decide on what discount rate you should use in your model. This will take account of your cost of capital and also the risk for the project. Neither of these is easy to decide on, and in fact, deciding how to do that would merit a whole session to itself, which we obviously don't have time for. In terms of sources of value, you'll want to demonstrate the additional value that your company can create compared with like kind of what Angus was focusing on a couple of slides ago. As you said, this could be generated by the use of superior technology, or you might have tighter control of costs for some reason than your competitors. And you may want to show two models, one without that added value and one with. I understand from Angus that tended to be the practice within BP. Decision quality is not. I think this is something that Angus remembers from BP. This is about identifying how robust the key inputs to the model are, because this will help decision makers to assess how much they can rely on the model outputs, the NPV and the IRR, when making their decision. If they fall in the view that the model is not very robust, then they will probably do their own discounting before making a decision, and they're therefore less likely to give the project the green light. On risks and uncertainties, clearly the risks in this kind of project are lower than for pure exploration projects, but there will still inevitably be a lot of uncertainty, particularly around how much the field might be able to produce, and even more so if the available data is old or of poor quality. So you'll almost certainly want to supplement a base case model with upside and downside cases. And in an upside case, you may well want to apply a higher discount rate, because clearly the risk factor in an upside case is higher. And just an example from my own experience, I was many years ago finance director of a listed oil company in London, and their basic approach to modelling was to do a base case using an NPV of say 12%, and they would do an upside case which they used a discount rate of 15%, and then when they decided what price to bid for, they essentially took a range between the two. But it's by no means an exact science, and every company will have different ways of doing things. Okay, back to you, Angus.
Thank you. Okay, so look at the economics there. Let's now, we're still on the why we would invest, and we're turning our attention now to the downstream. What further processing will be required of the oil, and what cost is associated with that? And initially we're thinking here about removing impurities from the oil. So water, sand, any gas that might be present, any contaminants such as H2S if it's a sour field, which is unlikely in Nigeria. So we're cleaning it up so that we can get the oil in a marketable form, so that it's sellable, and also so that it can be transported, and particularly if we're sharing infrastructure with other fields. So there may be opportunities for either using other people's infrastructure or sharing any processing with a refinery or a terminal. So there could be some trade-offs with the upstream. Where does the processing investment lie? Should we invest upstream at the field, or should we invest further downstream in the value chain? And of course, while we talk about the value chain, the exemplar of this, I always think, is ExxonMobil, because you often found, certainly in the old days, that Exxon would have a field and connected by pipeline to a terminal and then onto a refinery. So they were playing the whole value chain. And of course, in this situation, you can derive significant operational, commercial, tax type synergies. Now, I'm not suggesting for 1 minute that we would be able to play the whole value chain within the marginal field opportunity, but there might be certain aspects of it that you could leverage. So think more broadly across the value chain. Let's not constrict ourselves to the field production itself. And then there's the issue of control of infrastructure. You'll be in a fantastic competitive position, or likely to be, if you have infrastructure in the area. And that might not just be the pipelines and terminals. It could be also trading. So there might be trading synergies that you're available to you to leverage. Okay, so that's a little bit about the downstream. Let's hop over now to the how and the when of investing. So the how and the when we will make our investments, and what we need to cover in the business case. So we'll talk firstly about the granting instrument and particularly the petroleum regime and the OML that will be operating under. As I understand it, these will all, the marginal fields will all be within existing OMLs. And so the terms that are available to us are quite clearly set out. It is an existing document, and we should be able to see quite what the terms are that we're signing up for. But what may be less apparent is how the OML has been used in practice. If these are older and they have been around for a number of years, it's a question of how they have been interpreted by the various parties and any precedents that might have been set over time. Of course, we'll need to understand the fiscal terms, so what taxes will be liable for, and the stability of these terms, and take a view on whether the investor is protected in any way. Minimum work requirement is an interesting one because there will obviously be an expectation of work being done to develop the assets by the government. And in fact, as I've seen, there will be a 5-year period where there will be a review of work done to see if it's satisfactory. But what does that actually mean? What do the terms of the OML actually require people to do? And so what is the minimum work requirement that the investor is anticipating getting involved with? And for that reason, we'll need to know the timings involved and any major milestones. And this is particularly important in the marginal field case because we will be entering into a development decision at some point. So how will that development approval be sought by the investor, and how will it be given by the government, and what constraints might there be in place around that, particularly around timings as to how quickly that has to happen. Okay, so let's turn our attention now to the development stage. Now, I do want to spend a couple of minutes on this because clearly, in the case of marginal fields, we're talking about a development play. So that is the heart of the business case, is around how are you going to develop the field. It's the major proposition. So it's not an exploration play. It's not a production play, at least not initially. It's really a development play. And so, of course, the development you can think of as coming in 3 parts. There's concept selection, where you look at a number of alternatives. There's the field development plan, where you work up your selected alternative. And then, of course, there's the implementation phase for the project. So at some point in the life of the asset, we will need to come up with a field development plan that will show how the oil is to be recovered, how many wells will be drilled, what and where those wells will be drilled, what facilities will need to be put in place for processing, for example, and how the oil will be transported to the market, so the offtake arrangements. So the crucial point that I want to highlight here is that these things should be under consideration at the bidding stage, of course. So we'll need to come up with a view of the life cycle costs for the project. So for the entire project, what do we anticipate the development costs, production costs to be? How much production do we expect to get? What reserves do we expect to recover? And we plug all that into our economic model to give us a view today on the anticipated economic benefit of investing in the asset. So this is a very important exercise. And of course, obviously, once you get to the asset, once you've won the bid, you get to the asset, you get access to more data, you will change your view, but it's crucially important that at the outset we have a view. And of course, when you're developing a field, there's usually lots of trade-offs to be made. For example, a big trade-off is usually around how quickly you produce the oil and what investment you wish to make. So for example, do you wish to invest more to allow you to produce more earlier? And these trade-offs will need to be given some initial thought at the bidding stage. But of course, you'll do that in much more detail once you've won the bid and you're doing your detailed concept selection. There will be major milestones to consider throughout the development phase, and this is something that we'll want to know about as we build up the business case for bidding. What are the significant milestones for project activity and investment, and also resource availability. It might not be a factor for all marginal fields, but there may be some marginal fields that are in areas where there's also a lot of project activity. So what does that mean for getting access to resources for your project? Will there be a constraint on service companies, for example, in a particular area? And then, of course, the major risks that need to be taken account of. And we'll talk about risks in more detail shortly, but of course, the big ones at the development phase are cost overruns, schedule overruns, and also performance once the development is started up. Okay, over to you for finance, Daniel.
Okay, well, this section is essentially about how much money do you need, when do you need it, and how are you going to access it. I was talking in the last section I spoke about the financial model. The financial model will obviously will enable you to calculate how much money you need for the whole project. So that's the source of the answer to that first question. You're obviously going to want to keep the amount of capital you need to a minimum, but you need to be realistic. Just really coming back to the point Angus just made about the risks of overruns. If your funding capacity for the project is too small and you can't cope with the impact of cost overruns or delays in getting it into production, you could end up being unable to meet your commitments under the license, which obviously would be a problem, to put it mildly. Again, in terms of phasing, the financial model, which because it's a time value of money-based model, will be done on a period-by-period basis, will provide you with the data you need to decide when you need the funding. And you'll want a clear understanding of the interaction of early revenues and later CapEx spend. It may be that the work can be phased so that part of the CapEx is funded once you have revenues coming in, which will reduce the gross amount of capital, or net amount of capital rather, that you need. It may also be possible to reduce your capital needs in other ways. For example, you might be able to start with cheaper temporary facilities on site and only install the more expensive permanent facilities once production revenues are being generated that can pay for them. So there are ways you can look at to try and minimize the amount of funding you need. It probably goes without saying, but the business case should set out clearly what use the funds are going to be put to. And in terms of source and cost of funds, how a project is funded is very much dependent on the circumstances of you as the bidder, but also of any partner you team up with. Funding could be from existing resources, if you have the capacity. It could be from new equity, or it could be from debt. I have to admit, I don't know a great deal about the Nigerian capital and debt markets, but the fact that these marginal fields all include discoveries, so that we're looking at development projects essentially rather than exploration projects, might increase the potential for debt financing, possibly secured on future production. Obviously, one last point, if you're planning to team up with a partner with existing capital to invest or with better access to new capital, that will obviously determine how much capital your company will need to invest, because it may be that the value you're bringing is more the expertise or the local knowledge rather than the capital, and therefore they can fund the lion's share of, or a larger proportion of, the capital requirement. Okay, back to you, Angus.
Okay, I think we're sticking with you, aren't we, for infrastructure? That's the next one.
You're quite right. Yes, continue. Infrastructure is also me. Angus has talked a little bit about offtake requirements already, but obviously how you manage the offtake of oil and gas produced will be a critical aspect of project viability, both from an operational and a financial perspective. The characteristic of these marginal fields, they're going to be generally close to other developments, so they are likely to be within reach of existing pipeline infrastructure. If that's the case, you're going to have to determine whether there is spare capacity in the pipeline, because it's great having a pipeline nearby, but if it's used to full capacity, that's no good to you. And if there is spare capacity, what tariff the pipeline owner is likely to want to charge you. And the supply and demand dynamic will determine how good a position you are in to negotiate a good rate. And it's going to be quite key to the project economics as a whole. So you're going to want to try and assess that before you put your bid in, so that you can factor it into your model. If the pipeline is working at minimal capacity, then you'll probably be able to negotiate a good tariff. But on the other hand, if the pipeline owner has the upper hand, because capacity is limited, then he'll be in a better position to charge a higher rate. One example from my past life, actually going back to the same company I was talking about before, one of the golden rules of my boss was that if you are a smaller investor investing in an existing area, in this case usually the North Sea, do your best to try and invest in somewhere where there is competing infrastructure, because if you can trade, if you've got more than one pipeline that you can access, then you've got a much better chance of doing a deal than if you've only got one to deal with. Whether that's possible in this environment, I don't know. If there's no existing infrastructure close by, you'll need to assess the feasibility, both technical and financial, of building it. And you'll need to bear in mind that you may have to truck production initially before pipeline infrastructure can be built, or indeed afforded. Trucking will be costly and may bring operational HSE issues with it. For example, is the route safe? Can the road and bridges along the route cope with the additional traffic? The next 2 points on the slide really lead on from this. As these fields are likely to be relatively modest in size, using existing infrastructure is likely to be more economic for you and will reduce the project's capex and funding requirements. On the other hand, if there's no existing or available infrastructure nearby, you'll have no choice but to build your own, and we'll have to factor these costs in accordingly. On the last point, other infrastructure, really the key thing is just don't forget them. If the project does require new roads or bridges, the cost could be considerable. And if you haven't factored this into your modelling, your project valuation will be overstated accordingly.
Okay, thank you, Daniel. So getting towards the end now, just I think it's two more points to make, and then we'll get into the Q&A session as quickly as we can. So HSSE, health, safety, security, environment. So really at the business case stage, we need to have an appreciation and demonstrate that we've considered what the major hazards are that are present, or the major environmental insensitive issues that may be presented by the opportunity. And so we need to satisfy our investors and also the government that we've made these considerations, and also have a management process in place to manage these once we start the work. So there may be local considerations for you in the particular area that you're in. So it's very location specific, and a well thought through business case will show evidence of the risks being identified and mitigations put in place to, if not remove the risk, then significantly reduce it. Another aspect might be CSR, so corporate social responsibility. If there's particularly local community opportunities for working with the local community, or support required from the local community, then I would expect to see some consideration of CSR issues, corporate social responsibility, outlined in this section of the business case. And then lastly, last but not least, supply chain and logistics. Now, I've been involved with many of these business cases over the years, and I have to say the vast majority of them don't pay too much attention to supply chain and logistics, but I think it is important in some projects, and particularly in a project like the Marginal Fields, where we really are talking about the development phase. And of course, a big feature of the development phase is getting equipment and supplies in the right place at the right time and at the planned cost. So we need to take supply chain seriously. So that there may be some considerations depending on your local circumstances that you may need to build into your business case around procurement and the supply chain and logistics. And so it's worth giving some consideration to factors like risk management for your equipment and supplies, optimizing specifications. So do you want to over specify in some areas because you see you're willing to take the extra cost, perhaps because you see there's some benefits in doing that, and also consideration of the total cost of ownership. So equipment and supplies is not just about the acquisition of those things, but also about the transportation and storage. And for some of the marginal fields that are located in the swamp area, this could actually be quite a challenge. You may already have supplier performance management. You may already have these processes in place if you're an existing oil company with existing operations in country. If you don't, you'll want to give some, if you're a new company being formed, explicitly to bid on the marginal field, you'll want to give supplier performance good consideration. For the more complex projects, perhaps for one or two of the bigger marginal field projects, you might want to actually get involved in categorizing and category management for your suppliers so that you can take a more strategic approach to critical suppliers. So supply chain, not for every project that we do, but it might be important for your project. So definitely worth giving some consideration to as you're developing your business case. Okay, so with that, we're at the end of the formal part of the presentation. I'm sorry we've overrun a little bit. We did start a little late and we've overrun a little bit, but we're very happy to take questions and just have a discussion. So if you do have any thoughts or would like to share some insights or ask a question, I think what I would encourage you to do is use the chat function. So just hop across to the chat area. I know many of you have been doing this already, and ask your question there. Okay, so hopefully you can see your chat. It's in the toolbar. If you can't see it immediately, then go to your toolbar in Zoom and head along to the More area, which is 3 dots, 3 horizontal dots, and you'll see that chat is located there. Okay, so we'd love to hear your questions. Please let us know if you have any thoughts or would like to share anything or ask a question. And perhaps to kick us off while you're thinking, let me ask Daniel a question. You mentioned, Daniel, that you were involved in mature field redevelopment in Central Europe. In that project, what did you see were the main challenges that were presented to you?
Well, probably the biggest challenge specific to the fact that it was field redevelopment rather than a an exploration project, for example, was the fact that we had an arrangement where we were entitled to the incremental production, the new production we could create from the redevelopment work, and another party, the existing license holder, benefited from the baseline oil production. That sounded fine in theory, but in practice, it made it very difficult. We had all sorts of problems working out at times what was baseline production and what was incremental production, and therefore who was entitled to the revenues. I'm not sure that would apply exactly in these marginal fields, but what you may find is that if these fields are close up against existing fields, and you drill a new well close to the margin, and you find yourself draining a reservoir that possibly goes underneath into the next field, that would raise similar kind of issues about who is entitled to the revenues from that production. And so that's something to bear in mind if the field you're bidding for is close up against other existing fields.
Yeah, and I suppose we could extend that area of entitlement to the granting instrument, because we're working in the marginal field case, we're working within existing OMLs, and the marginal field itself will be carved out of that OML. But where does the old OML and the new OML, if we can call it that, start and finish? So what if the field is bigger than anticipated? Does that stay with the marginal field owner? If there are any prospects nearby, or other discoveries nearby that haven't been developed, how would they come into the equation? So we need to scrutinize the OML very carefully on that one.
Yeah.
Okay, let's have a look. Question. Here's one. My question: how long do you think that the oil sector would remain viable to tap into these shared ideas, given rising environmental concerns? Wow, that's a great question. Do you want to tackle that one, Daniel?
I don't have a crystal ball, I'm afraid, so no. I think your crystal ball is larger than mine. Can I throw it back to you?
Okay. I mean, that's a great question, and this is not unique to marginal fields, of course. This is a question that's posed to the whole of the industry. And I think if we look at this from the macro view, I think most people take the view that oil and gas is going to remain very important for quite some time to come, for many years to come. And even when the world has transitioned towards a more balanced energy system, with perhaps your renewables being higher, there'll still be a very important role for oil and gas. So that is something that we need to have in the back of our minds, because clearly for some of the very, very big projects that last over many decades, that will be a consideration. But I think for the smaller projects, and we would include marginal fields in that, and particularly those where we can be very nimble and get development and production up and running quickly, then I think the risk is much lower. So I don't see it being a big factor in this particular situation. It will be interesting to see what sort of feedback we get from investors and the financiers on this, as and when folks go out to raise funds for these projects. But I would anticipate that won't be a big factor right now. Okay, here's another question from Peter. Thank you for this. How can we minimize the risk of financial loss when you are bidding for a oil well which you have no access to its viability, which I assume means is the data question? Any thoughts on that, Daniel? How can we minimize the financial risk when the quality and quantity of data might be lacking somewhat? let's say?
Well, I mean, I'm afraid that's a fundamental, isn't it, of any oil investment project. The fact that these are development projects, and for the most part, as I understand it, there will have been existing at least one well drilled on each field, means that you will have access to some information. So you're in a better position than if it was a pure exploration play. But I mean, you just have to do your homework as far as you can with the available data, and you have to build in risks accordingly when deciding how much you're prepared to invest. And but it's that's the fundamental risk of the oil business that I think you can't really escape.
Okay, here's a question from Tolu. Thank you for this, Tolu. And it's for me. Question for Angus. What overall constraints do you see for smaller fields with remaining resources less than 10 million barrels? So I'll give you the North Sea experience, and the North Sea experience is really around infrastructure. So that the big thing that holds up the development of small pools in the North Sea is infrastructure. And so the regulator, at least in the UK sector of the North Sea, has been paying a lot of attention to making sure that there's fair and equitable access to infrastructure for the small fields and their owners. But a thought that I have for the marginal fields, and I think this speaks to your question, Tolu, is now obviously each marginal field will be different, but if I was looking to bid on one of these fields, I think one of the questions I'd ask myself is why has the field lain fallow for so long? You know, these fields by definition have been around for at least 10 years. So the question is, why hasn't it been developed up until now? And so you need to really challenge yourself to understand the asset sufficiently to answer that question, because it's a critical question. We need to do our research on this. Why has the specific field that you're looking at lain fallow for 10 years? And what is it about your company that can make the difference in this case? And I rather suspect that a big angle to this will be in the subsurface, and particularly doing appraisal. And so a lot has changed in the world in the last 10 years. The industry cost structure has changed. The technologies available have changed, you know, lots and lots of things. So taking looking at a field with a fresh pair of eyes, and in particular, perhaps investing in appraisal. It's an area where we haven't really done very well as an industry across the world. We haven't spent enough money, and haven't spent the right money and the right activities on appraisal activities. But I think this could be a big area for the marginal field. So what do we mean by appraisal? Well, traditionally it could mean drilling another well, but that might not be justified for a small pool. So we have to think of other things. So it might be, for example, shooting new seismic or reprocessing seismic that we already have. So think a little bit about the appraisal, and I wonder if that might be one of the constraints that we're facing here with the marginal fields. Okay, here's one from Collins. Thank you for this, Collins. It's around the finances. So I'm going to line you up, Daniel, for this one, please. The financial requirement for the bidding can nudge close to $400,000 if you're interested in bidding on 3 fields. So about $120,000 per field. What are the options open for some startup companies that have scaled pre-qualification to raise part or all of this money from the market? So we're talking about raising a small amount of capital to get some of these smaller startup entrepreneurial firms into the bidding process. Any thoughts on that, Daniel?
I'm not sure I can give a terribly helpful answer, because I think this is quite a country-specific issue, and how the capital markets work in Nigeria will drive that, which I can't claim to be an expert on. I mean, what I would say is that quite often in these kind of projects, you'll find that by bringing in where a local company teams up with a larger international partner, the international partner can provide the funding. And I think, as I said earlier, the value that the local partner brings is not purely capital, and therefore it's the local expertise and knowledge and involvement, etc. So that can reduce the amount that the local company has to put in, who is the more capital constrained of the two. So that doesn't directly answer your question, but finding a partner can be a good way of minimizing the amount of capital you have to raise.
Yeah, I suppose, these smaller entrepreneurial startup firms play a really important role in our business, in any industry, actually. That's the truth. But these are the people that are actually willing to risk some money and their time in building up these businesses from the ground up. And many, it's often overlooked actually, but many governments and bigger companies rely on these entrepreneurs to actually get the ball rolling, to do the business development. So I wouldn't be at all surprised if we saw, some smaller companies, new startups that, are formed just to get through the bidding stage. They may be able to pick up one or two of the opportunities and then partner with a much bigger company that has the resources available. And if you are one of these small entrepreneurial companies, then you'll need to convince, first of all, DPR that you have the technical expertise, and that you will at some point get the financial backing. So it's about credibility in the technical and the finance area, and that's really about the people that you've got on your team. Who's involved? What's their track record? Are they credible? I don't know the specifics for how this is being run by DPR, but there might be scope in the way that they're running the bidding process for these groups to be formed and play quite a major role. I know in the North Sea, for example, in the recent licensing rounds, the government has said, has allowed for smaller groups that might not have the financial backing today, but there's a reasonable expectation that if they do win the license, that they will be able to get financial backing. And then that's all about the credibility of the team that's in place and their track record.
Can I just add one thing, which kind of goes back to something when earlier on Angus was talking about local, country, regional assessment, and said, I mean, not unreasonably, that probably that's something that you as companies are more likely to be aware of, and perhaps won't go into in that much detail. But on the other hand, if you are planning to work with a partner, one of the key things is to give the partner confidence that you have a full understanding and clarity around the local conditions and can help them to navigate that. So if you are making a business case that is likely to be almost a selling tool to a partner, then that actually will be particularly important to make sure that because local country risk will be a large element for them, and you need to show how you can help them manage those risks.
Okay, another question here. Discussions in the renewable energy sector, especially in the North Sea, center around the conversion of offshore oil platforms for use by offshore wind turbines, installation and use. How is the oil business in Nigeria likely to apply this reuse of infrastructure? Yeah, that's an interesting one. I don't know. I don't know the local situation with renewables. I can tell you what I see happening in other parts of the world, and it's really driven by the desire of some corporations, so a corporate desire to become have neutral emissions. So from their operations, have zero emissions. So net zero is the term that we use. And emissions of carbon dioxide, I mean. And so you see some operators flipping over energy consumption on their platforms and their infrastructure away from fossil fuels, away from burning gas, for example, and towards using renewable energy. So you have an oil platform that was traditionally powered by gas will now be powered by renewable energy. So the oil is still producing, but the use of hydrocarbons as the source of energy for the platform is reduced. So we do see that. I don't know for Nigeria. I mean, a critical consideration in the use of renewable in the energy in the oil sector is how reliable it is and what your backup is. So, for example, if you're installing wind turbines, it's not going to be windy the whole time, obviously. So, what do you do when the wind isn't blowing, and what's your backup, and ensuring that you don't have any interruption to operations, to production. Okay.
There's a question that's been asked a couple of times about thoughts on input data from third-party data sources. Which I don't feel hugely qualified to answer, except to say that in my feeling, particularly given that the nature of these fields, which are probably not on the major third parties' radar screens too much, and also the fact that there will be, because these are existing fields and there is data available for them, I would tend to assume that analysing the existing data, which is accessible as part of the bid round, it will be more valuable than turning to third party sources. I don't know if you have any feelings about that, Angus.
Yes, I think that's right. And I don't know about the commenting on the input data. It's very specific to the opportunity that you'll be looking at. But I will comment on the need to build in risk and uncertainty into our decision making. And of course, a prime way that we can do that is through the economic model or the financial model. And so I think what we're trying to avoid is a deterministic approach where you put one set of data into the model and get one set of outputs in terms of economic indicators like NPV, IRR, and to instead allow for any risk and uncertainty that's present. And so that's everything from doing sensitivity analysis, decision analysis, all the way through to doing simulation, which I know many companies do now. So that's where we input, our input data is expressed in the form of a range, a distribution curve, a probability distribution curve, and we can run a simulation and we get a range of the economic indicator in question, so NPV, for example. Okay, any other questions? Any other thoughts? Did we miss any, Daniel, that you saw?
No, I think they've all been covered either directly or indirectly.
Okay, brilliant. That's some great questions there. Okay, so let's wrap this up. I just wanted to finish off quickly with this last slide, thinking about further support that WBC might offer to the folks that are getting involved in the marginal fields work. We're going to do an online version of our 3-day MBA in oil and gas, probably in August. It'll have to be quite soon, given the timeline for Marginal Fields. So this will be our regular 3-day MBA, but with some marginal field emphasis, some specific content around the marginal fields. So it'll be exclusively for folks from Nigeria, and we'll probably run that in August. So let me know if that might be of interest for you or your colleagues. We also thinking of putting together some virtual workshops to address specific issues on the marginal field bidding. So these workshops would typically be 1 to 2 hours long each and would address specific aspects. For example, the bidding process, legal aspects, asset management. So what are you going to do with the asset once you've won it? Asset valuation, which we touched on today, and any CSR, corporate social responsibility aspects. Please let me know. I'd love to hear your feedback on whether you think the MBA might work for you or whether there would be interest in pursuing some of these virtual workshops. Okay, the only other thing I wanted to mention just quickly before we all sign off is the next webinar that we have is a webinar on leadership. It's a week today, so that will be Thursday, the 6th of August. It'll be at 1 p.m. London and Lagos time. We've got a great presenter lined up to go through some leadership aspects in our industry. So please let me know if you'd like to attend that. If I can, I'll just put the link to the web page in the chat box so you can get more details on that there. Okay, well, I think that's it. Thank you very much for your kind attention and for joining us today. Apologies that it ended up on a bank holiday for you, or a holiday. I think when we set this up, we anticipated that the holiday would probably be Friday to Monday, and as it's turned out, it's today and tomorrow. So I really appreciate your attendance today. Great turnout. I hope you found the session useful, and look forward to keeping in touch. Thank you and goodbye.